Hey there, future chartered accountants. If you're serious about scoring full marks in cost and management accounting, you've got to have a rock-solid foundation. And today, that's exactly what we're going to build, piece by piece. Let's get right into it.
So, let me ask you a question right off the bat. Do you really, truly know the difference between costing, cost accounting, and cost accountancy? Just think about it for a sec. They all sound pretty much the same, don't they? A lot of students just use them interchangeably. But is that right?
Well, here's the thing. ICAI definitely knows the difference. And you know what? Getting these terms mixed up is one of the quickest, easiest ways to just throw away marks in your exam. It's a classic trap, and by the end of this session, you are never going to fall for it again.
Okay, to make all this stuff real, let's imagine we're helping out a new t-shirt startup. Their designs are awesome, sales are through the roof, money's coming in, but when they look at their bank balance, they're totally confused. Are they actually making any money on each t-shirt? They have absolutely no clue. This problem they're facing? It's the exact reason cost and management accounting exists. What they need is a toolkit to figure out what's really going on inside their business. And that's what we're going to do for them, right now. We're going to build that toolkit, starting with the absolute fundamentals.
So, first things first, we need to learn the language. These definitions we're about to cover, think of them as the nuts and bolts of our entire toolkit. If you get these right, I promise you, everything that comes after will be so much easier to understand.
All right, let's start with the most basic word, cost. What is it? Super simple. It's just the amount of any resource you give up to get something else. So for our t-shirt startup, this is everything. It's the money they spend on the cotton, the dyes, the electricity for the machines, the rent for their workshop, even the designer's salary. All of that is cost. Okay, next up, costing. See that ing at the end? That tells you it's an action. Costing is the actual process of finding out the cost. It's the how-to. It's the steps you take to add up the cost of the cotton, the dye, the labor, the electricity, to figure out the exact cost of making one single t-shirt. It is the technique and process of ascertainment.
So, you've used costing to figure out the numbers. Now what? Well, that's where cost accounting steps in. This is about being systematic. It's the formal process of recording all those costs, classifying them correctly, and then putting them into useful reports. You're moving from a rough calculation on a piece of paper to a proper, structured system for tracking every single rupee.
And now for the big one, the one that trips everybody up, cost accountancy. Please listen carefully, because this is a classic spot to lose marks. If costing is the process, then cost accountancy is the whole science and art behind it. It's the application of all the principles, methods, and techniques of both costing and cost accounting. Its goal is to control costs and figure out profitability. So, to be super clear, costing is the doing, but cost accountancy is the entire framework, the science that tells you how to do it right.
And that brings us to management accounting. You know, what's the point of collecting all this data? It's to make smarter decisions. Management accounting takes all that juicy information from our cost accounting system and presents it in a way that helps managers plan, control, and make big strategic choices. It helps our startup answer questions like, hey, which t-shirt design is actually making us the most money? Should we maybe stop making the yellow one? Can we afford to have a sale on the black ones? That is management accounting right there.
Okay, so we've got the definitions down, but you might be thinking, why would a small business like our t-shirt startup go through all this trouble? What's the real point? Let's talk about the objectives.
Let's run through these for our startup. First, ascertaining cost. They desperately need to know how much it costs to make one t-shirt. Why? For the second point, determining selling price. You can't set a good price if you don't know your cost. Then we have controlling cost and cost reduction. The system helps them see where money is being wasted so they can become more efficient. And finally, the big one, assisting management in decision-making. With this info, they're not guessing anymore. They're making smart, data-driven decisions. This is literally what a cost accountant is hired to do.
All right, our t-shirt company is sold. They need a costing system. But listen, just getting any old system isn't good enough. It has to be a good one. And this is important because ICAI loves to ask theory questions about the essential features of a good costing system.
So think of these as the 5 golden rules. Number 1, it's got to be tailor-made. The system for a t-shirt company is going to look way different from one for a car factory. Number 2, the data has to be accurate and authentic. It's the old saying, garbage in, garbage out. If your numbers are wrong, your decisions will be wrong. 3, it needs to be uniform and consistent.
You have to use the same methods every time so you can actually compare this month's performance to last month's. 4, it should be integrated with your other systems like financial accounting to save time and effort. And finally, and this is so important, it has to be simple and clear. A complicated report that no one understands is just a waste of paper.
So, we know why we need a system, and we know what makes a good one. Now let's get down to the nitty-gritty. What are we actually calculating the cost for? And this brings us to two really important terms: cost objects and cost units. Now, in your study material, you'll see this sentence, which sounds a little, well, academic. But all it's really saying is that the cost object is the absolute center of the universe for any cost analysis. It's the starting point. Before you do anything else, you have to answer the question, what am I trying to find the cost of?
So what is a cost object? It's literally anything for which you want a separate cost measurement. The most obvious example is a product, like our custom t-shirt. But it could also be a service, like a home delivery option they offer. It could be a huge project, like opening a new store. You can even zoom in and make a single activity, like the process of placing an order with a supplier, your cost object. Or you could zoom out and say the entire production department is your cost object. Whatever you're measuring, that's it.
Okay, so if the cost object is the what, then the cost unit is the how much. It's simply the unit we use to measure and express the cost of that object. It's really straightforward. If your cost object is a car, your cost unit is per car. If your cost object is electricity, your cost unit is per kilowatt hour. It's that simple.
Okay, now I need you to lean in and pay close attention here. This table is an absolute goldmine for MCQs. I cannot stress this enough. ICAI loves to test whether you know the standard cost unit for different industries. For automobiles, it's per number. For cement, it could be per ton or per bag. Transport is a classic, passenger kilometer. For hospital, it's per patient day. Seriously, memorizing this table is picking up free marks in the exam.
We've covered a ton of foundational concepts, from the core definitions all the way to objects and units. But let's just pull back for a second and look at the big picture. Why does any of this really matter for a business?
Well, it all comes down to this. All of this work, all this tracking and calculating, it leads to a really powerful business strategy called cost leadership. This is a famous idea from Michael Porter. It means you aim to be the lowest cost producer in your industry. If our t-shirt startup can master its costs, it can either sell its shirts for less than competitors or sell them at the same price and make a bigger profit. Either way, they get a huge competitive advantage. That's the end game.
And just like that, we've done it. Think about it. We started with a completely clueless t-shirt startup. And now, by understanding the difference between cost, costing, and cost accountancy, by setting up a good system, and by identifying the right cost objects and units, we have built their complete foundational toolkit. They can finally figure out their costs and start making smart decisions.
Cost classification sounds fancy, but it's really simple. It's just grouping costs that have something in common. But don't let the simplicity fool you. Getting this right isn't just about passing this one chapter. It is the absolute foundation, the bedrock for your entire cost sheet, and honestly, for most of the problems you're going to face in this paper. Okay, so the ICAI material gives us 6 key ways to classify costs, and we're going to go through every single one. We'll look at them by nature or element, then by function, by behavior, by controllability, normality, and finally for managerial decision-making. We're not skipping anything. We'll cover it all one step at a time. All right, let's start with the big one, the most fundamental classification, by nature or element. You'll see this flows perfectly into the next one, which is classification by function.
You know, at the end of the day, every single cost, literally every pesa a business spends, can be boiled down to just 3 things. It's either a material cost, a labor cost, or some other expense. That's it. Simple, right? But, and this is the important part, the real game starts when we split each of these into 2 subcategories.
And that big split is between direct costs and indirect costs. Now, this distinction is absolutely crucial. So think of it like this. Direct costs are the ones you can physically point to and say, yep, that went into this specific product. They're the main ingredients. Indirect costs, which we call overheads, are more like the supporting cast. You need them to run the show, but you can't really assign them to just one actor or one scene. They're for the whole production.
Okay, let's zoom in on the direct costs. First up, direct material. Super straightforward. This is the stuff that's physically in the finished product, and it's a big enough cost that it's worth tracking. The perfect example is the cloth in a dress. You can see it, you can touch it, you can measure how much you used. It's a textbook, direct material. Okay, now listen up, because here comes the exam trap. I need you to pay close attention to this. What about the thread used to stitch that dress? I mean, technically, it's in the final product, right? So it should be direct. But, and this is a big but, ICAI loves this one. Because the cost of that little bit of thread is so tiny, it's just not practical or economical to track it for every single dress. So what do? We treat it as an indirect material. I'm telling you, this is a classic spot where students lose marks over and over again. So besides direct material, you've got direct labor. That's the wages you pay the people who are actually physically making the product. And then you have direct expenses, which are a bit rarer, like maybe hiring a special machine just for one specific job. Now, when you take these three, direct material, direct labor, and direct expenses, and you add them all up, you get the first really important number on your cost sheet, the prime cost. Okay, so once we have our prime cost, that's our foundation. From there, we start stacking on the overheads, and we do it in a very specific order, based on their function. We keep adding these layers until we get all the way to our final cost of sales. This right here is classification by function. It's a logical journey. First, on top of prime cost, you add all your production or factory overheads. Think factory rent, the supervisor's salary. That total gives you your factory cost. Next up, you add the administration overheads. Office staff salaries, printing costs. Now you've got your cost of production. And for the final step, you add the selling and distribution overheads. Things like advertising, the cost of delivery vans. And voila, you've arrived at the total cost of sales. See, it's a logical flow from making the product right to getting it to the customer.
All right, let's switch gears. We're moving on to our next big classification method. Now we're going to look at costs based on their behavior. And what that really means is, how does a cost change when you make more stuff or less stuff? This is so important for making smart business decisions.
So in this world, there are two main characters, fixed costs and variable costs. Fixed costs are easy to remember. Think of your factory rent. The total amount stays the same whether you produce one widget or 10,000. But, and here is the key point for your exams, the fixed cost per unit actually gets smaller the more you produce. On the other hand, you have variable costs, like your raw materials. The total cost goes up in lockstep with your production, but the variable cost per unit always stays the same. You absolutely have to understand this per unit behavior. Of course, in the real world, things are never that simple, right? A lot of costs are a mix of both. We call these semi-variable costs. They've got a fixed part and a variable part. The classic example everyone uses, because it's perfect, is your phone bill. You have a fixed rental you pay every month no matter what. Plus, you have a variable charge that depends on how many calls you make. So the total bill changes, but it doesn't change in perfect proportion to your usage. Now, in an exam, they're probably going to ask you to split these semi-variable costs. Let's just quickly look at illustration 2 from the study material. It says we have a semi-variable expense of 3,000 rupees. And the question gives us the key info. It's 70% variable. Well, that makes it easy, doesn't it? The variable part is just 70% of 3,000, which is 2,100. So what's left? That has to be the fixed part. 3,000 minus 2,100 gives you 900. And that's it. This is a practical skill you've got to be comfortable with.
Excellent. We are on to our last set of classifications. Now, these are a little different. They're less about the nuts and bolts of building a cost sheet and more about how managers actually use all this cost information to control the business and make good decisions. So this next slide gives us a nice overview of all the key terms we need for controllability, normality, and decision-making. Let's just run through them real quick. Okay, let's do a quick rapid-fire round on these. Controllable versus uncontrollable. Simple. Can a manager actually do something about it or not? Normal versus abnormal. Normal cost is what you expect to spend. Abnormal is something unexpected, like a big machine breaking down. Standard cost. That's your target, your predetermined ideal cost. Imputed cost. This one's interesting. It's a cost where no money actually changes hands, like charging notional interest on your own capital. And finally, differential cost is just the difference in total cost between two alternatives. So, we've now covered all the ways to classify costs, but to make this a truly complete revision, we have to look at those theory questions at the end of the chapter. Don't skip these. ICAI loves asking them. This is all about taking what we've learned and applying it to different industries. All right, question 7 is a classic match the following for industries and their costing methods. This table right here is basically your cheat sheet for that.
For service businesses like transport, hotels, or hospitals, you use operating costing, with units like per room day. For something like a steel mill where production is continuous, that's process costing. A massive, one-off project like building a bridge, that's contract costing. For something complex with many parts like a bicycle, it's multiple costing. And for a simple, uniform product like bricks, it's single or output costing. You really just have to memorize this table.
And then question 8 is even simpler. It just asks you to list the methods of costing. We've pretty much just covered them. The whole list is single, batch, process, operating, contract, and multiple costing. Just knowing these names and what they're for can grab you some easy theory marks. Okay, just to wrap things up, let's cover a couple of final theory points. You might get asked the difference between cost and management accounting. Just remember, cost accounting is about control. Management accounting is about decision-making. And the limitations of cost accounting? Well, for one, it can be expensive to set up. You also have to reconcile it with your financial accounts. And yeah, there's some extra work involved. It's good to just be aware of these points.